Assalamualaikum warahmatullahi wabarakatuh. My name is Yasir dan introduced bin Yasir Fuadin Shah, matrix number 076295 from the IB5.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Izzul Fikris bin Mazuki. My matrix number is 075615.
Assalamualaikum warahmatullahi taala wabarakatuh. My name is Muhammad Arash bin Zulkifli and my number matrix is 075505.
Warahmatullahi wabarakatuh. My name is Ahmad Atikullah bin Salman. My matrix number is 075728.
I will talk about company profile or introduction to the Hab Seng Industries Berhad. Hab Seng Industries Berhad is Malaysia's most established food manufacturing company. They are known for its delicious biscuits and confectionaries. Hab Seng Industries Berhad started small but evolved as a brand name with Malaysians having faith in it generation by generation because of its quality and affordability. Hab Seng Industries Berhad founded in 1958 by the Kirk brothers in Batu Pahat, Johor. They incorporated as Hab Seng Industries Berhad in 1991. They listed in Bursa Malaysia main market in 2000. Hab Seng Industries Berhad is one of Malaysia's most established food manufacturers, famous for biscuits and confectionaries. For the three key divisions for Hab Seng Industries Berhad, the first one is Hab Seng Perusahaan Makanan Sendirian Berhad. This company is main production unit for cream crackers, cookies or biscuits. Second is Hab Seng Hon Yong Brothers Sendirian Berhad for marketing and distribution arm with 9,000 retail point. And the last one is in Comic Food Industries Sendirian Berhad. This company produce instant beverage, 3-in-1 coffee, tea, acquired in 2005. So, apart from its commercial achievements, Hab Seng Industries Berhad also attach enormous significance to corporate governance and sustainability. The company's issues annual sustainability reports as per the sustainability reporting guidelines of Bursa Malaysia and the Global Reporting Initiative (GRI) principles, such as reports demonstrate HSIB's strict adherence to social responsibility, ethical businesses conducts, and preservations of the environment, and testimony to its contribution towards sustainable development along with long-term value to stakeholders.
Today I will present an analysis of Hab Seng Industries Berhad through the lens of good or lending practices and creditworthiness evaluation. Let's begin with the principles of good lending as they apply to Hab Seng. First, safety. Hab Seng is recognized as a long-standing company with strong financial and a low credit risk profile. This provides assurance of stability to lenders. Number 2, liquidity. The company maintains strong current assets and cash flows, allowing it to meet short-term obligations comfortably. This is essential for smooth operation and financial resilience. Number 3, collateral. Hab Seng owns tangible assets such as building and machinery, which serve as reliable loan security, minimizing the lender risk. Number 4, capacity. With low debt levels and high interest coverage, the company demonstrates strong ability to repay loans. This reflects robust financial management. And number 5, profitability. Hab Seng consistently records stable revenue and healthy profit margins, making it a low-risk candidate from a profitability standpoint. Number 6, purpose. The purpose of borrowing is well defined. Loans are used to enhance core business operation, showing strategic financial planning. And the last one, character. The company has a solid reputation with no legal or ethical concerns and practices transparent governance, a key consideration in lending decision. Now let's look at the traditional 5C of credit, a standard framework used by financial institutions to assess creditworthiness. Number 1, character. Hudson demonstrates trusted management and a clean, respectable reputation. This builds lender confidence in the organization. Number 2, capacity. The company shows strong earnings and consistent cash flow, both of which are critical for timely debt repayment. Number 3, capital. Hudson maintains a low debt to equity ratio and is primarily funded through shareholder capital. This highlights its financial strength. Number 4, collateral. The company owns valuable fixed assets which serve as effective security for any borrowing needs. And the last one, condition. Operating in the fast-moving consumer goods (FMCG) sector, Hudson remains resilient even during economic downturns. This reflects a stable external environment.
Next, I will talk about ratio analysis. The first one is profitability ratio. For the profitability ratio, the first one is gross profit margin. Gross profit margin for Hapsec Industri Berhad in 2022 is 96.1%, and for 2023 89.84%, and for 2024 is 95.62%. So this gross profit margin indicates the amount of profit which the company has to retain after reducing the cost of production, while it declined to 88.84% in 2022 from 96.1% in 2022. It rose to 95.62% in 2024. This indicates the company strengthens its cost control or pricing policy. Next is operating profit margin. So in 2022, the profit margin for Hapsec Industri Berhad is 85.9%, and for 2023 89.12%, and for 2024 95.50%. So this measures the profit remaining after deducting operating costs. It grew smoothly from 85.9% in 2022 to 95.50% in 2024, indicating that the company has effective operations and effective expenses management. Net profit margin. Net profit margin for Hapsec Industri Berhad in 2022 is 85%. For 2023, 89.9%, and for 2024, 95.50%. So, from the net profit margin, this indicates the ultimate profile after deducting all the expenses, including interest and tax. It indicates the operating margin and hit 95.50% in 2024, which indicates that the non-operating costs are extremely low, and the company is extremely profitable. So next is return on asset. Return on asset for Hapsang Industry Berhad in 2022 is 8.74%. For 2023, 28.82%, and for 2024, 68.45%. ROA specifies the degree to which the company is using its asset profitability. It rose strongly from 8.74% in 2022 to 68.45% in 2024, reflecting a highly effective utilization of assets and improved profitability. So the last of profitability ratio is return on equity. Return on equity for Hapsang Industry Berhad in 2022 is 8.83%. For 2023, 29.35%, and for 2024 is 69.65%. ROE expresses how well the company is able to employ shareholders' equity to earn profit. It rose from 8.83% to 69.65% within a period of 3 years, reflecting improved performance and satisfactory return to investors.
The current ratio reflects the company's ability to meet its short-term liabilities using its current assets. It's shown a sharp increase from 2.17 in 2022 to 20.97 in 2023, reaching 20.51 in 2024. This significant rise indicates an exceptionally strong liquidity position, where the company holds over 20 times its current liabilities in current assets. Such a high ratio suggests the company is in a very safe financial position when it comes to covering short-term obligation. So let's look at the quick ratio, which excludes inventory from current assets to provide a more conservative view of liquidity. Follow a similar upward trend. It rose from 2.17 in 2022 to 20.89 in 2023, and further to 20.43 in 2024. This means that even without relying on inventory sales, the company still has more than enough liquid assets to settle its short-term liabilities. The high quick ratio further confirms the company's strong short-term financial health and efficient asset management.
Alright, next we'll be talking about the solvency and leverage ratios. Now, this is for Hapsang Industries Berhad from 2022 to 2024. Now, let's begin with the total debt ratio. Now, this ratio tells us how much of the company's assets are financed by liabilities. Now, in 2022, it was just 0.00112, although it rose to 0.0177 in 2023. It slightly dropped again to 0.0172 in 2024. Now, this extremely low level shows that Hapsang relies very little on debt to fund its operations, which is a really strong indicator of financial stability. Now, moving to debt to equity ratio, we see a similarly healthy pattern. It decreased slightly from 0.0113 in 2022 to 0.018 in 2023, then settled at 0.0175 in 2024. Now, this suggests that the company is primarily financed through shareholder equity, not borrowing, again reducing the lender's risk exposure. Now, the debt to asset ratio, also at 0.0172 in 2024, supports this conclusion. Almost all of Hapsang's assets are funded through equity, not liabilities. Now, let's look at the company's ability to service debt. Excuse me. The cash coverage ratio, which measures how easily the company can pay its interest using cash flows, jumped from 5,738 in 2022 to over 43,582 in 2024. Now that's an enormous safety buffer and shows that the company has far more cash than needed to cover its debt obligations. Now similarly, the times interest earned ratio increased from 5,490 times in 2022 to a remarkable 22,749 times in 2024. Now this means Hapseng earns more than 42,000 times what it needs just to pay interest, highlighting almost zero risk of default. To sum up, these solvency and leverage ratios clearly show that Hapseng is in an extremely low-risk financial position with strong equity, funding, a massive ability to cover any debt-related obligations.
Today I will talk about ratio analysis. For inventory turnover, as you can see in the slide, for 2022 is 0.0217 times. For 2023 is 22.05 times, and 2024 is 24.16 times. Hapseng Industries Berhad's inventory turnover improved significantly from 0.0217 in 2022 to 24.16 in 2024, reflecting stronger sales, better inventory management, and more efficient operations. Next is receivable turnover. For 2022 is 98.003 times, and 2023 is 0.73 times. For 2024 is 1.53 times. This indicates how quickly the company receives money from customers. It fell very steeply to 0.73 in 2023 but recovered a bit to 1.53 in 2024. While still very low, the improvement indicates improved credit collections operations. Next is payable turnover. For 2022, 1.36 times. For 2023 is 2.01 times. For 2024 is 1.98 times. This indicates how quickly the company pays its suppliers. It stays quite steady at around 2 times, indicating normal payment habits. Okay, the next one is day sales in receivables. For 2022 is 3.72 days. For 2023 is 500 days, and for 2024 is 238 days. This is the number of days to receive receivable. It rose from 3.72 days in 2022 to a whopping 500 days in 2023, before increasing to 238 in 2024. This points to slow payments by customer, although it is on the improvement path. For the next one is day sales in payables. For 2022 is 268.4 days, and 2023 is 181.27 days, and 2024 is 184 days. This indicates how quickly the company is paying its suppliers. It fell from 268.4 days to approximately 184 days, indicating that Hapseng pays its suppliers sooner, and this could be as a result of tighter cash flow. For the last one is asset turnover. For 2022 is 0.1 times. The 2023 is 0.32 times, and 2024 is 0.73 times. This indicates how effectively the assets are generating revenues. This rose from 0.1 in 2022 to 0.73 in 2024, indicating improved asset usage to generate sales.
Now let's look at the relevant factors influencing Hapseng Industry Berhad's credit evaluation beyond just financial ratios. Now first up, Hapsang benefits from a strong brand reputation. As a well-known name in the Malaysian biscuit industry with decades of presence, its consistent availability on store shelves has earned it consumer trust and loyalty. Now, this reliability strengthens its image in the eyes of lenders and reduces perceived credit risk. Now, next, the economic nature of its product plays an important role since it operates in the food sector. Now, demand for its products tends to remain stable, even during inflations or economic downturns. Now, this resilience makes Hapsang a safer choice for lending compared to businesses tied to luxury or seasonal goods. Now, however, there are some risks to monitor, especially around raw material dependence. Now, this company relies on inputs such as wheat flour, sugar, palm oil, which are pretty sensitive to global price volatility. Now, if production cost rises and can't be passed on to consumers, this could compress margins. Now, on the operational side, the company has made major improvements. Inventory turnover jumped significantly from just 0.02 in 2022 over 24 times in 2024. Now, this shows better sale efficiency and also stock management. Now, on the flip side, receivables remain a slight concern with a turnover rate of 1.53 and day sales in receivables at around 239 days. Now, this suggests that customer payments are slow and also could affect cash flow if not carefully managed. That said, liquidity is extremely strong. With a current ratio of 22.51 and a quick ratio of 22.43, Hapsang can comfortably cover its short-term liabilities. Now, these numbers are far above the normal benchmark of 1.0, showing outstanding short-term financial health. Now, we should also highlight Hapsang's commitments to ESG principles, environmental, social, and governance. Now, lenders today increasingly favor companies that act responsibly, and Hapsang's focus on sustainability and ethical conduct adds to its appeal. Now, lastly, the company's credit history and bank relationships are very solid. Now, in 2024, it recorded a cash coverage ratio of 43,582 and a times interest earned ratio of 42,749. Now, these figures confirm its excellent ability to service debts and maintain trust with lenders. Now, in summary, these non-financial and operational factors combined with the financial data position Hapsang as a very strong candidate for credit approval. I'll be talking onto the credit worthiness assessment of Hapsang Industries Berhad. Now, overall, the company demonstrates exceptionally strong credit worthiness supported by excellent financial ratios and consistent operational performance over the past 3 years. Now, starting with profitability, Hapsang's margins are among the highest in the industry. Now, in 2024, the gross profit margin stood at 95.62%, while both operating and net profit margins were at 95.15%. Now, this shows that the company has outstanding cost control and the ability to retain a large portion of its revenue as profit even after expenses. Now, looking at returns, the numbers are even more impressive. Return on assets increased sharply from just 8.74% in 2022 to 68.45% in 2024, reflecting efficient use of assets to generate income. Now, meanwhile, return on equity reached 69.65%, proving that shareholders are receiving substantial value, that the company's business model is both sustainable and profitable. Now, in terms of liquidity, Hapsang is in a very favorable position. The current ratio reached 22.51 and the quick ratio 22.43 in 2024. Now, both far above the industry benchmark of just 1.0. This means that the company has more than enough liquid assets to cover its short-term liabilities and presents almost no short-term financial risk. Looking at solvency, the company continues to impress. The debt to equity and debt to asset ratios are extremely low, just 0.0175 and 0.172, now respectively. These figures indicate that Hapsang relies minimally on external debt and is primarily funded through equity, which keeps financial risk low. Now, even more convincing is the company's debt servicing ability. In 2024, Hapsang recorded a cash coverage ratio of 43,582 and times interest earned ratio of 42,749. These numbers are extraordinarily high and confirm that the company has more than enough earnings and cash flow to meet its interest obligations with ease. Lastly, in terms of efficiency, Inventory turnover rose to 24.16 in 2024, showing that goods are moving quickly. Now, although receivables turnover remain low at 1.53 and day sales in receivables are still high, around 239 days, the company's strong liquidity offsets any serious concern. Now, asset turnover has also improved to 0.73, which suggests better utilization of resource and generate revenue. Now, in conclusion, despite minor issues with receivable collection, Hubseng's overall financial position is extremely sound, with strong profitability, excellent liquidity, low debt, and a solid operational base. Now, the company is more than capable of repaying its credit obligations and stand out as a highly creditworthy borrower.
These are the recommendations regarding loan application for Hubseng Industries Berhad. Hubseng Industries Berhad is a highly creditworthy and financially robust company, making it an excellent candidate for the proposed 500,000 ringgit loan. Over the past 3 years, Hubseng Industries Berhad has demonstrated strong profitability, exceptional liquidity, minimal leverage, and improving operational efficiency, with profit margins exceeding 95% and substantial growth in both return on asset and return on equity. The company shows effective cost control and asset utilization. Its liquidity ratios far surpass industry standard, and its conservative capital structure indicates very low financial risk. Although receivable turnover is low, this is offset by strong cash flow and overall financial strength. Hubseng Industries Berhad's established market position, strong brand, and adherence to good governance further enhance its credibility. These are the conclusions. Hubseng Industries Berhad demonstrates strong and stable financial health, marked by consistent profitability, high margin, and effective asset utilization. Its strong liquidity and low debt level reflect excellent financial flexibility and minimal risk. Operational efficiency has improved, though receivable collection remains an area for enhancement. Overall, the company is highly creditworthy, with sound financial management and strong corporate governance, making it a low-risk and reliable borrower.